So taking a closer look at the TAMIM Credit Fund, talking about one of the underlying investments and managers that we work with in this portfolio, I think it's quite important to give you a bit of an insight into the types of managers and people that we invest with. This particular manager has been invested in, or we've been invested in through the life of the portfolio, around about 5 years now. Their name is Equasia, and as I say, they've been a key part of the credit fund since we started our portfolio. They've built out a diversified portfolio of private debt and targeted returns of around about 10% per annum. They've constantly delivered a strong performance with pretty low volatility, and the key benefits to the TAMIM Credit Fund have included them bringing diversification, capital preservation capability, and also an ongoing professional management of the loans that they would fund. They tend to follow a private debt strategy, investing across a number of industries and sectors. They will leverage their strong in-house credit analysis capabilities, and they also have a pretty unique network of deal origination capabilities. As I said, over their 5 years of operations in this particular fund, they've hit their targets of 10%, which we're quite happy about. Not only have they been strong performers, but the capital preservation qualities have been good. They've only ever had, similar to us, one negative month in their portfolio. And actually, interestingly, that negative month they had in our portfolio in the TAMIM Credit Fund, we were positive that month, which goes to show you the benefit of diversification in our portfolio. The manager is relatively small in comparison to some of the big shops out there, and they're focused on deploying cash correctly. So they won't take in cash, sit in it for a long period of time, because they understand that creates a drag on performance in terms of the funding that we provide to them. The loan portfolio they run has very limited construction exposure, around about 6%. But that construction exposure that they're holding in the portfolio is largely in completed projects, and they do tend to have a fairly diversified asset allocation position. Their lending team focuses very much on real estate lending, and that sits in the residential, industrial, and mixed use space. They also have other investments across opportunistic credit, specialty lending, and convertibles. Their portfolio at the moment is invested into about 23 loans, and the weighted average life of those loans is just over 17 months. So that means every 17 months on average, we'd expect them to be in a new set of loans. They've been moving away from mezzanine loans, and they've been moving themselves up the capital stack towards more senior secured lending over the last 12 to 18 months. And in the first quarter of this year, they had 7 of their loans repay and they issued 3 new loans with about $184 million of capital commitments coming up for them